Hello, ladies and gentlemen. Welcome back to our channel, where we dive deep into the world's most pressing economic issues. Today, we have an intriguing topic to discuss: the faltering economic recovery of China. In recent years, China has been making waves in the global economic landscape, with impressive growth rates and ambitious development plans. However, as we peel back the layers and analyze the current situation, it becomes clear that the dragon's roar is showing signs of strain. China, a powerhouse that has captured the attention of the world, has experienced tremendous growth over the past decades, transforming into the world's second-largest economy. Its resilient economic prowess seemed unstoppable, but as the global economic winds shift, challenges arise, and even the mighty can stumble. In this video, we will delve into the reasons behind China's faltering economic recovery, exploring the complexities of the situation. From trade tensions and geopolitical pressures to domestic challenges and structural issues, we'll uncover the key factors contributing to this unexpected downturn. Join us as we examine the ripple effects on global markets and discuss what this means for China's future as a global economic powerhouse. Throughout this video, we'll be joined by renowned economists, experts, and scholars who will share their insights and shed light on the intricate web of circumstances that have led to this economic downturn. We'll also explore potential strategies and solutions that China might adopt to reignite its economic engine and regain its momentum on the global stage. So if you're curious about the current state of China's economic recovery, the challenges it faces, and the potential implications for the rest of the world, you've come to the right place. Make sure to stay tuned until the end and subscribe to my channel and hit the bell icon as we aim to provide a comprehensive analysis and leave you with a deeper understanding of this critical issue. Alright, let's dive right in and unravel the faltering economic recovery of China. Initially, when COVID-19 restrictions were relaxed in China, it instilled a sense of optimism among investors and raised expectations of a robust economic rebound. However, the latest data indicates that China's recovery might be losing its vigor. Although there was a positive shift in the outlook when Beijing moved away from a zero-COVID approach, there are now other fundamental factors at play that are impacting the economy. Government crackdowns on the property and technology sectors, along with heightened scrutiny of private enterprises, have significantly affected China's economic growth. Consequently, Beijing has revised its GDP growth projection for 2023 to around 5%, reflecting a more cautious estimate compared to the historical average of 6%-8%. Furthermore, China faces additional challenges arising from the United States and a global economic slowdown, further dampening business prospects within the country. According to Ho-Min Lee, a senior macro strategist at Lombard Odier, it is anticipated that China's real GDP growth will average approximately 4% over the next 5 years. This projection considers the offsetting factors of a decreasing working-age population and consistent productivity expansion, as well as the aggressive investments being made in frontier technologies. Lee advises investors to prepare for a modest reduction in China's global market share. The waning momentum of China's recovery has sparked concerns regarding the consumer-driven growth in the country's economy. Market participants had initially expected that consumer spending would play a pivotal role in driving economic growth. While there was a rebound in retail sales earlier this year, the growth rate has shown signs of deceleration recently. In April 2023, China's retail sales witnessed a year-on-year rise of 18.4%. However, when compared to the previous month, the growth was a mere 0.5%, in contrast to the 0.8% growth recorded earlier. Moreover, the year-on-year figures fell short of the projected 21% growth estimate. CMB International highlights that Chinese consumers continue to exercise caution and selectivity in their spending patterns. This uneven trajectory of consumer behavior has led to an imbalanced recovery, favoring specific subsegments of the economy. In April, China's industrial activity experienced a growth rate of 5.6% compared to the previous year, falling short of the projected 10.6% increase. The National Bureau of Statistics, NBS, revealed that profits of Chinese industries witnessed a significant decline of 20.6% between January and April, in comparison to the same period in the previous year. In April alone, profits contracted by 18.2% year-on-year. These negative trends can be attributed to weakened overseas demand and a slowdown in domestic buyers, both of which have impacted the industrial sector adversely. New data reveals that China's factory activity experienced a more substantial contraction than anticipated in May, primarily due to weak demand. The official Manufacturing Purchasing Managers Index, as reported by the National Bureau of Statistics, fell to a 5-month low of 48.8, down from 49.2 in April. A reading below 50 indicates a contraction in the sector. Additionally, the non-manufacturing PMI for May also declined to 54.5 from 56.4, marking the slowest pace of expansion seen in the past 4 months. According to UBS Wealth Management USA, China's recovery in May displayed an uneven pattern, with the manufacturing sector showing signs of weakening, while the services sector witnessed a strong rebound. To address this imbalance, targeted policy support is expected to be implemented, specifically focusing on stimulating big-ticket consumption, housing, and infrastructure. This support measure could potentially be introduced as early as June. Nevertheless, some experts argue that the recent weak data should not necessarily be a cause for concern. They view it as part of a long-term trend in China, where there is a gradual shift from heavy industry towards services and consumption. This aligns with the government's ambitions, as officials have expressed skepticism regarding the reliability of an export-driven manufacturing sector as a sustainable economic engine. China's recovery is further influenced by the global economic slowdown. Trade data recently released by the Customs Department highlights a 7.5% drop in exports in May. This decline can be attributed to trade tensions with the United States and weakened global demand. Economists, including Lloyd Chan from Oxford Economics, anticipate that exports will continue to be subdued. They foresee a potential recession in the U.S. during the second half of the year and increasing pressures related to destocking. These factors collectively contribute to the challenges faced by China's export sector. Investors also express concerns about the record-high youth unemployment rate in China, which stood at 20.4% in April, according to data from the National Bureau of Statistics, NBS. This indicates that companies are encountering difficulties in hiring new graduates, despite the overall economic growth rebound. Furthermore, the weakening recovery in China has had repercussions on the stock markets, with the Shanghai Composite Index experiencing a decline of 3.57% in May. This downturn reflects the cautious sentiment among investors due to the challenges faced by the Chinese economy. Given the uneven recovery and the various economic indicators pointing to challenges in the Chinese economy, several asset managers have downgraded their outlook on Chinese equities. Prominent firms such as Pictet Asset Management, Morgan Stanley, and Goldman Sachs have recently revised their expectations for Chinese stocks. These revisions reflect the cautious stance taken by asset managers due to the prevailing uncertainties and risks associated with the Chinese market. Initially, there were optimistic expectations of a robust economic recovery in China following the relaxation of COVID-19 restrictions. However, recent data indicates that the recovery is losing momentum. Multiple factors such as challenges in different sectors, trade tensions, diminished global demand, cautious consumer spending, and high youth unemployment rates have all played a role in this situation. Consequently, asset managers are revising their expectations for Chinese equities. However, some experts perceive these developments as part of a longer-term transition within China's economy, shifting towards services and consumption, which aligns with the government's objectives. And that concludes our discussion on the faltering economic recovery of China. We hope you found this video informative and gained valuable insights into the challenges China is currently facing. As always, we encourage you to share your thoughts and opinions in the comments section below. Don't forget to like this video and subscribe to our channel for more engaging content on economics and global affairs. Thank you for watching, and we'll see you in the next video.